I walked into a local deli yesterday here in Manhattan to get a smoothie. And the guy that was working to make the smoothie was kind of disheveled, so I started talking to him, and he tells me that he's been running the entire store himself. It's a convenience store, a deli, and he's the person that's making the food, he's the person that's doing the cash register, he's the person that's stocking the shelves. And so we get to talking, and he tells me that he's the one that actually owns the store. And I said, well, why are you working alone? He says, well, I've been here for 7 or 8 hours all by myself because I cannot find more labor. I'm having a tough time finding employees. He said it's been going on, but the problem is not getting better. Interesting thing going on. Well, just 1 week ago, I'm in Detroit, the Metro Detroit area, and I met a worker from Burlington Coat Factory who tells me that their store has a problem. And the problem is that on weekends, they have so many customers enter the store and they don't have enough staff to manage the customers that they have decided to shut down the store on weekends. Now think about this for a second. You are a business. A business is in the business of selling stuff. You have a line around the door with people with cash and money in their hands ready to spend money in their store. You don't have the staff to manage all these sales, so you just shut down the store? It's an interesting dilemma we're starting to see. And at the same time, the Federal Reserve Bank is saying, well, we still have this inflation problem. If you remember the last couple inflation reports that we saw, inflation was actually ticking upwards. Why is the Federal Reserve Bank working to raise interest rates? They're working to raise interest rates to cool inflation down, meaning they want to cool down demand, they want to cool down spending. But Americans still have the ability to spend. How do I know? Because people are still spending money. Now, when people spend money, this doesn't have to necessarily mean the cash in their bank account. People can spend money or they can spend credit. That's the way that our economic system works. You can spend the money you work hard to earn, or you can spend money on your credit card, or you can spend a home equity line of credit. It doesn't matter in our economic system. Money, whether it's debt or whether it's cash in your bank, is the same in our economic system. And what we're seeing happen is that people still have the ability to spend. And until people lose that ability to spend, our economy will continue to be hot. But we are starting to see a shift happen right now. And that shift is happening due to the higher interest rates, because we have raised interest rates at the fastest rate in pretty much the last 4 or 5 decades right now. The last time we raised interest rates this aggressively was back in the late 1970s, early 1980s. That was the last time we faced a real inflation crisis. And the thing about raising interest rates is that higher interest rates make borrowing money more expensive, not just for people, right? When you go to buy a home, it's more expensive because of the higher mortgage rates, but it's also for businesses. Because now if you're a business and you want to go out and borrow money to invest in a new machinery, a new office, it costs more money. But it's also more expensive for governments because our United States government now has to pay out higher interest rates when they go out and borrow money, because our government has a large spending problem. Our government keeps spending money that they don't have, and then they have to finance the spending with the help of debt, and then they have to pay interest on this. And we're seeing interest payments on our national debt also rise. But if you look at now, what is the impact of higher interest rates? Well, we have had multiple rate hiking cycles happen in our modern historical economy. And what we've seen happen is that in the last 14 rate hiking cycles, 11 of those rate hiking cycles ended with a recession. So the question is, are we going to see more economic pain? Well, if we look at history, out of the last 14 rate hiking cycles, 11 of them ended with a recession. And this current rate hiking cycle that we're seeing right now is the most aggressive interest rate hiking cycle that we have seen since 1981. Now, if we go back to 1981, when we raised interest rates this aggressively, what happened? We saw a recession in 1982. Now, the 1982 recession wasn't a mild recession. It was a pretty severe recession. To put it in perspective, in 1982, there was 10.8% unemployment during the peak of that recession. Now, to kind of put that in perspective, a 10.8% unemployment in 1982 during that crash, compare that to the 2008 crash, where the peak unemployment hit 10.6% in 2010. That was the peak during the 2008 crash. So during the 2008 crash, peak unemployment was 10.6. During the 1982 recession, it was 10.8. So raising interest rates have an impact on the economy, which brings me back to that original question of what's going on with spending and when are we going to see a real slowdown in spending? Now, this is something we've been covering in Market Briefs. Market Briefs is my free financial newsletter. If you have not joined Market Briefs yet, it's a free and easy way for you to stay up to date on what's happening in things like the economy, the stock market, the housing market, crypto, and the global economy. It's a fun, witty, and easy to read email. You can read it in less than 5 minutes every morning, and it's completely free. So if you have not joined Market Briefs yet, I got the link for you down in the description below. But now when we go back to now the topic of when is the spending going to stop? Well, it goes back to understanding, well, what is the money? Money can be the cash in the bank, or it can be the debt that you have access to. And we've been talking about this for a little over a year now, where people have had the ability to spend. What we've been seeing happen for the last number of months is that people have been digging into their savings. People have even been digging into their 401k accounts. People have been digging into their home equity lines of credit. And the kind of general consensus from a lot of different economists and people is that by the end of 2024, they're saying sometime between October and November of 2024, that is when the cash part of our spending is going to be decreasing or kind of essentially wiped out, because people have been going deeper and deeper into their savings and into their life savings or 401ks. So the expectation is that by October, November of 2023, this year, that savings portion will be done. But that doesn't mean that spending stops, because people still have the ability to spend on their credit card. And people still have the ability to spend based off of their home equity, because if you bought a home in the last few years, chances are you have some equity in your homes. And for the banks, this is a great time to advertise, well, you can pull that cash out of your home and just start spending that home equity. Now, this is a very bad idea, but this is how banks make money. And this is where on September 1st, Fortune magazine put out an article titled "American Families May Soon Max Out Their Credit Cards," top analysts warn, and could be hung out to dry. Now, I'll link this article for you down in the description if you want to read it for yourself. But essentially, what this article talks about now is that Americans have been eating at their savings, like what I was talking about. But then they go a little bit deeper. When will Americans run out of the ability to continue swiping on their credit card? Because remember, our economic system is spending based off of money. Money is credit, and money is the cash in your bank. Now, we know the cash in people's bank accounts are kind of running dry. But the question is, when do people run out of the credit? And what this talks about is that, I'll read you a line. By the second quarter of 2024, the entirety of households' pandemic war chests will be spent. Meaning, the prediction, according to these analysts, is that now the second quarter of 2024, April, May, June 2024, that's when people will lose out on the ability to continue swiping on their credit card and potentially home equity. Home equity is a much bigger kind of question mark, because we have such a low inventory of homes available for sale still. People are still willing to buy homes with the higher mortgage rates. So home values are still high. And if home values stay high, then people still have the ability to spend on that home equity. But when it comes to credit cards, it looks like the prediction now is that April, May, June 2024 is when that spending ability goes down. Now, if spending goes down, what does that do? Well, if our economic system runs on spending and spending stops, that means the economic growth stops. And that's the real concern, because we've been seeing the red flags. I've been talking about the different things happening in the economy. I've been talking about the yield curve and understanding now the risks with that. I've been talking about the impacts of the higher treasury rates. I've been talking about the impacts now of, well, what's going on with all this spending. People have been digging into their savings. People have been digging into the credit card debt. People have been digging into the 401ks. All of these things are red flags. And you have a lot of people saying, oh no, we're past the worst. We've passed the pain in this part of the economic slowdown. Startups have already started to feel the pain. It's all going to be sunshines and rainbows after this. But we haven't even started to see the economic pain yet. And this is why I keep saying 2023 is not the year for you to go out and finance a truck. 2023 is the year for you to get financially smart. This is the time right now for you to, number one, be financially educated, understand what are the different investment opportunities out there, how do you start investing, How do you build that financial education? And number two, how do you build the financial preparedness? How do you put aside some cash to protect you against an emergency? How do you put aside some cash to be able to capitalize on opportunities? Because if we continue to see more economic pain, if we continue to see higher interest rates, if we continue to see more economic slowdown, if we continue to see higher unemployment, by the way, the latest unemployment numbers came in at 3.8%. Still extremely low, historically low unemployment. But you're starting to see unemployment start to trickle upwards because earlier this year, unemployment was 3.4%. Now we're at 3.8%. And don't forget, the Federal Reserve Bank is expecting unemployment to go to 4.4%. And for us to get to 4.4% unemployment would mean that 1 million Americans would still have to lose their jobs for unemployment to hit that level the Federal Reserve Bank expects. So this is where it's important for you to understand what's happening, build that financial education, build that financial preparedness. That way you're not one of the people that gets blindsided by what's going on, because people are still spending. We have this weird dynamic in the economy where people got money to spend, but people don't feel the need to work. And when you can spend but don't need to work, that's a big dynamic shift. And when that thing goes back to normal, when people have to work but don't have money to spend, that's going to create a huge shift in our economic system. It's going to create a lot of anger, a lot of resentment, a lot of emotions. And that's the time where you want to make sure that you're prepared before then. That way you're not one of the people that's panicking, freaking out, and suffering because of that. And that's where that financial education comes in.